The Federal Reserve has claimed that they would drop off the garbage debt that they own and allow the market to pick up the pieces. That was back in October. Well, they have been cutting back to a very small degree, and in fact, we haven't seen this low level since 2014. Could this signal the end of QE? You came here for the truth, so let me unveil that for you. Today we're going to look at the Fed, we'll look at the stock market, debt, and so much more. A jam-packed episode for you today. Let's begin with the Fed balance sheet. You can see that it has been declining consistently over the last few years. That is a very clear trend. It is back into the levels, as I said, from 2014. So they will put this message out there into the financial media to tell everybody that things are going along as planned. But what I want to stress to everyone is that if the Fed was at approximately $4.5 trillion in this time frame, and they have been consistently bringing that level down, we are at $4.4 trillion. From 2014 up until this time frame, 2018, they've brought it down this small amount. Imagine how long, even if they pick up the pace, imagine how long, imagine what year it will be when the Fed's balance sheet is close to zero, or even a few trillion, because apparently a few trillion here or there doesn't make a difference. It's going to take years and years, decades. And that assumes that there is no reason to need to reverse course and start QE4. Think about the potential here. The Federal Reserve always, 100% of the time, acts too slowly, and they never do this on time. They're never on time, always late to the party. In conjunction with that, we've been told by the Treasury they forecast another 10 years of continuous growth without a recession that would lead to the longest period without economic contraction in history. And of course, this is based on their projections. It won't take long, though, as you will be able to see in the near future. I'm sure that we will see this business cycle expanding into the record regardless. Now, whether or not it's going to go another 10 years of growth, I don't know about that. However, there has been maximum levels of intervention, and as a result, they've been able to sustain the stock market rise. This will all change, however, if that balance sheet actually does take a dip. If interest rates actually do rise, we will see the negative consequences of that in the markets. All right. Goldman Sachs has a message for us. How much is at risk from higher rates? Roughly $1.2 trillion. Impact of a 100 basis point rate shock versus the notional value of bonds. And you'll see that for yourself here. It's important to think about the repercussions of interest rates rising. If interest rates rise, everything in the financial industry is affected by it. Then you have the ripple effect, where jobs are lost as a result. You have many businesses out there who simply can't afford to do business when rates are at a normal level. And so, unfortunately, people lose their jobs, businesses go under, and that's the way it works. The S&P price to sales ratio, I've shown you this before, and while it looks like it isn't currently at the peak, does it really matter? Look where it has come since the financial crisis. Just one more indicator to pile up. Now, Nothing to worry about here, but the total U.S. household debt soars to a record above $13 trillion. You don't need to worry about this because, of course, as many people believe, we are going to be bailed out. They think that the Federal Reserve bailed out all these companies all around the world during the financial crisis. There was a TARP bailout that bailed out yet again big banks and big corporations during the financial crisis. But this time around, people believe, some people, that the average person will be bailed out. Well, we'll see about that. Looking at this, the report said it was the 5th consecutive year of annual household debt growth, with the increases in mortgage, student, auto, and credit card categories. Everything has increased. Everything, every bad thing. More Americans are taking on auto and student loans. You could see it for yourself where this has grown over the years. Doesn't surprise me, not one bit. No matter what you're looking at here, you're going to see additional debt. The government, personal, state, counties, cities, provinces, doesn't matter. No matter where you look around the world, there's more debt, worse deficits. This I thought was quite interesting. I'll just touch on it very quickly. You may not be able to see, the font is quite small. S&P 500 price action in 1987 and 1962 bear markets and comparing it to what happened in 2018. And essentially what this is trying to argue is that this is the beginning of the bear market, right? So I'm not necessarily saying that because we haven't seen much deleveraging or anything like this. But the initial sell-off in 2018 was almost 12%. You look at 1987, it was less than 9%, and 62 is about 7%. How many days? 10 versus 9 and 32. Talks about the numbers here, the peaks, and bounce off the initial low to close, 7.88. I mean, it's basically trying to show when you compare them, somehow 2018 looks even worse. But we don't know what's happening here. I mean, we've seen the stock market rising like crazy. It dropped down rather significantly, but it will simply continue its trajectory upward. How far it goes, I don't know, but eventually we're going to have an event. We'll see how far it comes down from that point. There is going to be these trigger moments that occur along this path. You're going to have major failures that exist. Depending on what those failures are, will determine how far this declines. It's just a simple matter of fact. If they can heal the wounds, or at least make it seem like they're healing the wounds rather quickly, we may not have that many dominoes that fall this time around. Okay, the Treasury Secretary had some strange things to say. There are a lot of ways to have the economy grow. You can have wage inflation. This is a quote, okay? You can have wage inflation and not necessarily have inflation concerns in general. Right. I'm going to read that one more time. You can have wage inflation and not necessarily have inflation concerns in general. I am presenting that with no additional comment. I think it is absolutely ridiculous. All right, just 3 quick things here. I'm not going to get into details. It's something that I try to cover, and I always struggle for the words. People living on the streets, obviously, it's becoming worse and worse. Well, if you are in LA, you're going to have a big problem with that. If you don't have a place to stay and you're staying in your car, let's use those words. Well, they've made that officially something you're not allowed to do. So they're going to be enforcing this. And it's in effect as we speak, as I record this video. 2018, parking apparently on residential streets from 9 p.m. to 6 a.m. is now banned. So if you're doing that, because that's the place you live, that is officially banned. It is prohibited. They're counting this. I mean, I don't live in LA. I don't know the actual number, but this seems low to me. That 7,000 people are living in their cars in LA. It wouldn't surprise me to see this much, much higher. That's their estimation. Right. Now, that's the way it is. I'll just leave it at that. You know, I can't cover that type of information. Okay. I just covered what China was doing with Anbang, and now you can see HNA. Others out there were saying cover HNA, cover HNA. It's a bigger situation. Obviously it is. This is essentially here, let me highlight it for you. The amount of dollar bonds outstanding for the conglomerate and its units at $13.7 billion. That accounts for more than 1% of Asian high-yield bonds outside of Japan, raises the question of the impact on the broader market. In fact, this goes through, talks about the different companies that could be affected by any sort of default of HNA. And what's funny about this article out of Bloomberg is that it suggests, don't worry, it lists like a bunch of different companies that would be affected by it. And then it basically says, don't worry about this one, don't worry about this one, don't worry about this one, minimal risk, minimal risk. And it goes on. It's a joke, but anyway, we'll see. They also were just literally days before the financial crisis were telling us that everything was fine. So, I mean, I'm just sick of being lied to, really. At this point, it's a sickness to read this and not be able to see through the between the lines here. Very quickly, out of China, they are blocking this purchase that's happening here, this potential purchase here, and it's a Massachusetts-based provider of equipment for testing computer chips and circuit boards. They're withdrawing from its $580 million sale to an investment group backed by a Chinese government-controlled fund. So essentially, the Chinese government wanted to come in, buy up this company that makes chips and circuit boards, testing them, and they said no. They stepped in, said no, you can't do it. And I do believe that this is something that will continue to happen. We saw what's happening with Hollywood. There's going to be a lot of this fighting back and forth from both sides. So I think it's interesting regardless. I know that this is not a big sale necessarily in the grand scheme of things, 580 million, but I know that we'll see more. We'll definitely see more as time goes on. I'm not going to give my opinion on it. I'll just specifically mention that this is a fact. It's going to escalate. It's going to get more common as time goes on, especially if we start to see, let's call them discounted prices. So we'll see the acquisitions increase generally in tough times. So keep an eye on that. If you found the video informative, please give me a thumbs up. Last but not least, if you found this video informative, I know you'll find my books, The Money GPS and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books if you go to Amazon. The links are in the description below. Take care.